Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. Let me ask you a question. You buy a $2 million apartment building. It's a great deal. Cash flows $80,000 in the first year. Come tax time, your accountant tells you that after expenses and standard depreciation, you have a paper gain and you owe $20,000 in taxes. Now, a professional investor buys the exact same building. At tax time, their accountant tells them they have a $474,000 paper loss that wipes out their entire $80,000 gain and shelters nearly $500,000 of their other income. They're not paying $20,000, they're getting a massive refund. What's the difference? It's not magic. It's not a loophole. It's a strategy. They've mastered the paper loss power play. Today, we're diving deep into cost segregation. Here's the key. This is the single most powerful tax strategy available to real estate investors, and 90% of amateurs have never even heard of it. And thanks to the One Big Beautiful Bill Act that passed this year, the same one we mentioned in episode 101, this strategy just got supercharged. This is a core part of the research and manage phases of your Prime framework. Let's get into it. When you buy an investment property, the IRS lets you depreciate it. This is a non-cash or paper expense that you can deduct from your rental income to lower your tax bill. But here's the problem. The IRS makes you do it slowly. For a residential property, they force you to depreciate the building over 27.5 years. For a commercial property, it's 39 years. Now, I think this is a terrible deal for the investor. $1 in tax savings 20 years from now is worth far, far less than $1 in your pocket today. That's the time value of money, a core principle of finance. You hire a specialized engineering firm to conduct a study that legally segregates the components of your building. They identify all the parts that aren't structural building and are instead personal property or land improvements. Now, let's think about it. The concrete foundation is part of the building, 27.5-year property. But what about the carpets in the hallways, the kitchen cabinets, the appliances, the parking lot asphalt, the landscaping? That's not part of the building structure. That's 5-year, 7-year, or 15-year property. Here's the data. A high-quality, engineering-based cost segregation study can often reclassify 20% to 40% of a property's total cost basis, excluding land, into these shorter life categories. Now, say, on our $2 million apartment building, let's say the land is worth $500,000 and the building structure is $1.5 million. Wait, let's use a simpler example from the research total purchase price, $2 million. The study reclassifies 25% of that, or $500,000, into 5 and 15-year property. Instead of depreciating that $500,000 over 27.5 years, you now have the right to write it off much faster. This single move is the key. You've just pulled decades of future tax deductions into the first few years of ownership. But that's only the first part of the equation. This is where the accelerator gets floored. Cost segregation on its own is powerful, but when you combine it with bonus depreciation, it becomes an explosive first-year wealth-building engine. Bonus depreciation is an IRS rule that lets you deduct a large percentage of the cost of that 5, 7, and 15-year property all in year one. Now, folks, you have to pay attention because this is the biggest financial news of the year for investors. As we mentioned in episode 101 on 1031 exchanges, the One Big Beautiful Bill Act, OBBBA, was signed into law on July 4th, 2025. This is a monumental shift. It completely reversed the old painful phase down of bonus depreciation. You'll remember it was 80% in 2023, 60% in 2024, and was scheduled to be a disappointing 40% this year. Well, that's gone. OBBBA permanently reinstated 100% bonus depreciation for qualified property acquired and placed in service after January 19th, 2025. The uncertainty is over. 100% is the new permanent rule. Let's do the math on our $2 million building, which we're placing in service today, in November 2025. Step 1. Cost segregation. We reclassified $500,000 into short life property. Step 2, bonus depreciation. The OBBBA bonus depreciation rate is 100%. Step 3, deduction. In year 1, you get an immediate bonus deduction of $500,000. That's 100% of the $500,000. Step 4, the rest. You also get your normal straight-line depreciation on the remaining $1.5 million of the building's structural cost. $1,500,000 divided by 27.5 years is $54,545. Your total first-year paper loss isn't the tiny amount you would have gotten. Your total deduction is $554,545. Now, let's go back to our scenario. The property generated $80,000 in real cash flow. That $554,545 paper loss completely wipes out that $80,000 gain and still leaves you with a $474,545 passive loss that, depending on your tax status, you can often use to shelter your other income, your 9-to-5 job, your spouse's income. Capital gains from stocks. That's the paper loss power play. You collected $80,000 in real cash, and your accountant tells you that you legally lost over $500,000. You just gave yourself a 6-figure tax-free cash advance from the IRS. This is where we put it all together. This is the strategy that truly separates the institutional professionals from everyone else. It combines 3 powerful tools, all of which we've now covered on this podcast. The 1031 exchange from episode 101. You sell a property and use a 1031 to defer all your capital gains taxes from that sale, rolling your equity into a new, bigger property. The cost segregation study. On that new property, you immediately perform a cost segregation study and identify, let's say, 25% of the new higher purchase price as short-life property. 100% bonus depreciation. Thanks to OBBBA, you use the new permanent 100% bonus rule to take an enormous paper loss in year 1 on the new property. Do you see what just happened? You used the 1031 to defer all taxes on the way in, and you're using cost segregation and 100% bonus depreciation to eliminate all taxes on the way out of that tax year, plus shelter hundreds of thousands of dollars of your active income. It is the ultimate 1-2 punch. You defer your old gains and you create massive new deductions. But there is a trap. There's always a trap. The IRS doesn't just let you take $500,000 in deductions without asking for something back down the line. What happens when you sell this property? The IRS will want its money back in what's called depreciation recapture. And that is the fatal flaw we're going to cover in the next episode. Let's recap. Cost segregation is an engineering-based study that reclassifies parts of your building from 27.5-year property to 5, 7, and 15-year property. The One Big Beautiful Bill Act now lets you take 100% bonus depreciation on all of that reclassified property in year 1. This allows you to generate a paper loss so large it can shelter all of your property's cash flow and a massive amount of your active income. Your challenge today, this is a simple one. Look at a property you already own or one you're analyzing that you acquired this year after January 19th, 2025. What was the purchase price? Now take 25% of that number. That's a conservative estimate of the 100% bonus depreciation you could potentially be claiming this year. Write that number down. That's the cash you might be leaving on the table by not thinking like a pro. In next episode, we're building the machine. We'll cover who to hire. An engineer, not just your CPA, what a real study costs, the perfect candidate property like multifamily, self-storage, or data centers from episode 59 and 62, and most importantly, the fatal depreciation recapture trap and how to avoid it indefinitely. You don't want to miss this. I'm Martin Maxwell. Keep learning, stay strategic, and keep building.